Unmuted.
Hi, good morning, afternoon or evening to attendees of this Danko webinar, joining us from, I guess, multiple time zones and continents. So I guess they're all quite busy people, so thank you very much for taking time out of your diaries to attend this webinar. As mentioned in the introduction, my name is Anthony Elwine. I'm responsible at Damco for the chemical and industrial verticals, and it gives me great pleasure to present trends in the chemical industry and their impact on global supply chain. As also mentioned in the introduction, it would be great that I can speed through the presentation and hopefully spare some time in the 45 minutes that we have today to come back to the questions that are aired during the presentation. Also in the presentation deck, I understand that some questions may be deemed confidential that you don't want to ask in a broader audience. So later in the slides, you will see that my personal contact details are included to give you the opportunity to also reach out to myself directly. As the industry is far-reaching in terms of scale and subsegments, I've not been able to isolate specific areas, but I believe the material enclosed in the presentation will hopefully stimulate enough to cause you to reflect positively on the time you're committing to this webinar. As a global vertical head, I'm somewhat fortunate in that I get a lot of time to spend with our customers in the chemical industry, a number of which we've built long-term partnerships. And I'm fascinated speaking to these organizations when common themes seem to build over time. More and more customers are reporting that managing supply chain volatility, where external factors impact their supply chains, is creating a need for increased flexibility to mitigate or contain the impact of these challenges. From a chemical industry to a customer perspective, I'm also noticing that some changes are happening further upstream in their business processes to allow for increased responsiveness to customer needs and or segmentation, whilst also aiming to more closely manage their cash, order-to-cash cycles. This is a very difficult balancing act. A regular theme that's also discussed, which I'll touch on the presentation today, is around feedstock availability and the production centered around those feedstocks. Also, I hope to cover during the 45 minutes that we've allocated today the globalization and centralization of the industry, where things happen to be moving from regionally autonomous operating units towards a more global and harmonized approach, with one way of working through common SOPs, providing data which has not been available in the past, leading to material flow optimizations. Before leading into the introduction, I will also touch on a very brief overview of who Damco is as an organization to benefit those who are attending today who maybe don't know us so well. As we progress through today's webinar, see if you can find elements which may impact your results, how you might, as customers, be impacted or perhaps served even better, and from a personal perspective, in your role within supply chain, how might the information shared with you impact how you do things now and in the future. So without further ado, let's start to go through the webinar. So who is Damco? Damco is part of the AP Moller Maersk organization, a relatively sizable conglomerate operating in multiple fields of logistics. We have a large organization in terms of our presence and our footprint in many countries around the world today. Where Damco fits into that organization is within the services and other shipping part of the business, and we're acting as a supply chain management organization in addition to being a NVOCC or a freight forwarding company. The three boxes at the top are generally areas that are a ticket to play in the logistics service industry, while the bottom boxes are more focused around how companies can control and optimize their supply chain. Our business is focused on 5 core verticals. Our heritage comes from lifestyle and retail, where we've been active in those verticals for a significant period of time. And from those verticals, we're able to transfer knowledge and best practices into other verticals that need further development. Starting with some relatively positive news. The world market for the chemical industry is big. If you look at sales growth, 2012 versus 2013, the story is not so great. What we've seen here is growth of around 2.4%. But if you take a longer trend over a 10-year cycle, that growth is around just over 10% per annum in terms of sales. The main driver for growth has, of course, been Asia, and more specifically, China. Over the same period of time, 12 and 13, China sales have grown 14% to now represent twice the size of Europe. As you can also see on the slide, US and Europe are roughly the same size, and if in Europe you add Eastern Europe, you get a figure that represents around 20% of global sales. Over the same 10-year period, up to 2013, Europe has lost its crown as sales have fallen by 14.5 percentage points. And the NAFTA contribution to world sales has also seen a decline. Not as dramatic as Europe, but still a fall of some 9.2 percentage points. This is not to say that sales have not been growing in Europe and the US, but it's just that Asia has been growing a lot faster. Many reasons can be cited for these changes. This could be down to high energy costs, high labour costs, currency, regulatory, taxes, etc. Now looking at production, where the previous commentary was around sales. The three most important trading regions, NAFTA, Europe and Asia. Asia would be including China and Japan. Although Europe at 42.5% was the largest exporter, it seemingly lost its competitive edge when you compare to world export expansion. Between the early 90s and 2012, it's estimated that European exports have fallen by around 10% of the total market share. Energy and feedstock prices have and are Europe's Achilles heel, especially over a similar time frame compared to the Middle East countries who have thrived on a lower cost feedstock, where we are now seeing this starting to happen in the United States. Many of you are probably also aware of the multiple tens of billions that have been already committed to the US to capitalize on shale gas economics. You are also aware of the possible challenges that the oil downturn has implied towards some of these economies. What is more interesting are the challenges that lay behind this. As with any significant industrial changes, the local and wider government landscape tends not to be able to keep pace. This could also be said for the commercial world. Local logistical issues appear that were possibly not seen as such a significant issue in the past. Examples I would use here are customs working hours. If the ports do not extend opening times, will customs do the same? What about the availability of truckers? equipment from carriers, rail connectivity, etc. Depending on the GDP figures in the coming 2 to 5 years, in the US, the destination for most of this product could create a number of logistical challenges, which can always be overcome, but will this be at a cost? You also, at the same time, have the increased capacity coming to market from Asia and the Middle East over the next few years. This point we'll come back to later. In the last quadrant on the presentation, we've also highlighted the clear subsegments that exist within the chemical industry today. The purpose of this quadrant is to portray the point that the focus for today, although we cannot cover all segments, we have tried to aggregate a number of the data points that we have used, but we shall be focusing specifically on dry packed marine products. Looking at the next slide, hopefully in the previous slides we've been able to demonstrate what is happening in the chemical industry in terms of a production shift. New markets are appearing from a destination perspective, and emerging markets or heritage markets are also growing from a production perspective. Within the logistics industry, over a period of time, as the chemical industry has globalized, a number of those country or regional logistics service providers have migrated in tandem with their clients' businesses on a global basis. As geography is widening, more and more organizations within the chemical industry are looking to logistics service providers who can help them develop their business into new markets or emerging markets. There's also the concerns in the industry around risk and compliance. I have a problem with my slides. One moment. Apologies about that. Taking this into a context for the logistics industry, the heart of everything is chemical production. And what you have on the left-hand side is the ability to source materials from various parts around the world. And then to the right-hand side is how that products get delivered to the end consumers. And overarching is the planning activities that would take place to be able to deliver those products. The conclusion of all of this, from what we have assessed, is that there is a rethink underway in the chemical industry to look at how their models operate to service the market today, and they are considering the use of 3 and 4PLs to assist them on this journey. Also within this, we're seeing a broader shift for a switch of modes to obtain carbon efficiencies and become much greener in their supply chain. Green doesn't necessarily equal a higher cost to serve. It is often seen that this is the opposite, where more sustainable supply chains can benefit organizations. And once again, embarking on that journey, it's crucial that when selecting logistics service providers or partners in any form, that they can transfer the expertise from their market understanding and the corporate compliance perspective into those emerging markets to ensure that everybody behaves as good corporate citizens. The first section on this slide, although a number of you may or may not have worked in sales and marketing within the chemical industry, we've been surveying a number of our customers to understand what the future trends of the industry would be. And in penetrating new markets, in the past, a number of producers have worked with partners in those destination markets to help market their products. The trend from the past is likely to continue in the future, where accessing these markets will continue to be through trading partners. The implication in terms of supply chain is that the overall landed cost cannot be managed, but this also implies additional complications in managing the supply chain. What we are seeing more and more happening within the industry is that lead time to customers is becoming prevalent in terms of differentiation between how chemical producers can compete with one another. In the past, a lot of organizations have transferred product to destination warehouses to service their client base. And the trend that we see moving forward is more a switch to hub models, which would create additional flexibility within the supply chain. This also provides a cost benefit depending on how that hub model is structured. If you look at the economics around what is happening in the world today, in particular parts of the world, creating flexibility is driven externally and also within chemical companies' businesses to be more competitive in their cost to serve. In the past, a number of chemical companies have been looking at how would they package their products to service the destination markets. The perception several years ago was that the market would adopt to receiving bulk. This doesn't seem to have happened, which is a consequence of labour migration, moving from different parts of the world inland, if you were to use a reference point as China. Therefore, the ability or need to move to more bulk modes has diminished, but the aspirations of the industry is to look at servicing their customers in the future through bulk transportation rather than a lot of packaging material in the supply chain. Another question that is regularly brought to us, where we have canvassed a number of our key customers, is that how much inventory should I have sitting in my supply chain, and what would be the lead time to get my product to those customers? So in the next couple of presentation slides, you will also see areas where we've tried to understand what the market is saying and what best in class generally looks like. So here at the bottom of this slide, we've spoken to the different customers, and what we are seeing is in the lower box, so 10 days, is that customers have moved product to their destination warehouses to service the local markets. The middle box is more an indication of producers who've looked to use alternate methods to service their clients, which has given them additional flexibility. And the third is more in line with producers who look to produce and ship from origin to final point of destination. So this becomes a fine balancing act in terms of how quickly you want to get your products to the final markets. How do we see the future looking in terms of inventory? Again, we've run some comparisons with some of our clients. And again, what we see is that there is a significant difference between how a number of those companies would hold inventory within their business. This is also linked to the cost within their supply chain. In speaking to, again, a number of clients, that cost can vary significantly depending on how they look to segment their products, how they look to differentiate their supply chain. In the past, the standard approach has been a one-size-fits-all, but more and more we are seeing producers looking at having varying supply chains depending on the products they are producing and the markets they are looking to serve. I guess the question that comes from here is also linked around the sea transportation and us being part of the AP Muller-Maersk organization. So to prompt a question here is that what will happen in the sea transportation business in the future? And this would be, if we had a crystal ball, it would be wonderful. But what we are seeing is that there is additional capacity coming into the market from an ocean carrier point of view. What happens in terms of growth, seeing a slowdown in Asia and challenges within some of the BRICS countries, the growth of the market will certainly not be at the same level with which the ocean carriers have procured additional capacity. So we see challenges for the ocean carriers relative to the 61% that's mentioned in the box here. What we've also attempted to do in this segment is look at the different components where optimization opportunities exist for the chemical industry. In large organizations, you have significant procurement power, but you also need to compete on a global playing field. The mid-sized and smaller companies who don't have this power look to follow different routes to compete, either through product differentiation, or they tend to work more with NVOCCs who can then use the procurement power of that NVOCC to try and compete on a level playing field. Other companies follow a supply chain journey where they work with partners who can take them on a journey to move from an NVOCC status to a carrier direct relationship, because the volumes in the past have not been clearly understood within their business and the trade flows have not been aggregated to a global level. All of these scenarios have pros and cons, but it tends to be more a business decision rather than a cost reduction initiative. What is clear is that most of this is market driven, and it's not a sustainable way of control to remove costs in the longer term. The question we ask of our clients who are very procurement driven is how many of their suppliers are truly strategic partners, and how many of them are names that they have regular contact with but are not really behaving in a strategic way. The next box is around order fulfillment, or some of you may refer to this as order management. There's a number of significant benefits within the supply chain, and there are a number of pitfalls here. The immediate benefit of moving further up the process chain is that it enables a labour arbitrage. So what we are seeing more often is that companies are outsourcing or offshoring their order management processes. The challenge around this is that this is generally in lower cost economies, and in lower cost economies people are more willing to move organizations more readily. So having robust pipeline of talent and processes linked to this critical in looking at how you may look to offshore order fulfillment. An area where we do see significant opportunities through order management is in the optimization of supply chain orders. Typically what we see for a number of customers is that by receiving that order earlier in the process, it's then more possible to take multiple orders and look to consolidate or create flexibility in the supply chain to fulfill that order rather than waiting till later in the process to place a booking over the next leg. Transport planning. Similar to the above, but in the above, this step happens before the order is raised, whereas once the order is raised, a lot of hoops have already been approved. The opportunity to postpone that order has diminished, but there is still an opportunity to take that order and combine it with others and optimize the flows. Of course, your teams are or should be thinking about how to optimize their orders as part of their daily routine. The question we often ask is, are they doing this? Typically, we see them working to their maximum, servicing current operational challenges to commit any time to planning efficiencies. Transport execution. We discussed this also at quite some length. Why would I, a producer, outsource a task like this when my team know how to do it, other than you may be able to pay less than I do to your resources? With changing personnel, supply chain not being high on a lot of chemical companies' radar for many years, people being labelled as a cost to the business and not more accurately how they are creating value and increasing sales. The skills and interest to attract top talent in these roles has been difficult. Those who have outsourced these skills have a potential to also create a knowledge gap in their own company. If partnering here, what we see as being a key to success is ensuring that know-how through SOPs, etc., is very well documented. Done well, this can be used effectively to crack previous codes created internally or by other parties and ensure transparency is generated in task ownership and responsibilities. Freight audit and invoicing. Not an exciting area, but one which absorbs significant time within organizations across multiple functions. This can happen when paying their suppliers, and believe me, we feel the pain here, and when dealing with internal exchanges within departments. Automating these activities is becoming the normal within the industry. This is usually linked to corporate and financial governance, and costs to operate such an activity can be high for what appears to be a simple task, but can be complex depending on the organization. Performance analytics. Essential to manage day-to-day performance, but also to use a tool to see where financial and material flow processes can be examined and, if needed, changed to have a more positive outcome. We've typically seen this have significant impacts across organizations that have limited visibility internally through their ERP systems or externally through forwarder platforms or cloud platforms. By the time the data is extracted, sanitized, and then shared, the impact it has starts to become less meaningful. Increasing data awareness and speed within organization allows these performance discussions to take place and drive changes quickly. In terms of a customer overview and what we would look at best practices, we have been working with this particular client for a number of years, who operate in a number of different modes that will not be too dissimilar to the modes I would assume most of you transport products today. Bulk in this context refers to the movement within ISO tanks. And a lot of you will say, I don't have air freight, but the number of tenders we receive to move air freight around the world is quite incredible. And we understand this is a reaction to production issues, but the volume that moves is still quite significant. The client, when they came to us, had the challenge of how do I harmonize my processes within my organization to start and create a journey of how I will optimize my business. This journey commenced in Asia, where we worked with them in taking multiple processes and standardizing their way of working. On top of this, there was a digitization element to provide the information that was required for them to have visibility of what was happening within their supply chain. Once that part of the journey was concluded, we then moved on to handling their business in a different part of the world. This then gave us the opportunity to look at how we can start to optimize their flows to and from Asian and European markets. Once this optimization journey started, we were then able to look at how we would start to seize the initiative in terms of scalability within their business. So at the final point of the journey, once processes, digitization and optimization had started, it was then time to leverage scale. The webinar details will be sent to you. As I mentioned earlier in the presentation, I've included my email address for you to be able to reach out to me directly. I guess it's now time to go to the floor and look at some questions. Okay, the first question I have here is around optimization and savings and how do we get there, or what is the saving to be achieved. This is obviously a difficult answer to focus on specifically. So a generalization would be that we have seen savings in the range of anywhere between 5 to 21%, depending on the business improvement areas. But this also depends on the business strategy of our clients' desires to be able to deliver a relevant output. Moving on to the next question. What are the big ticket items? Good question. I think as mentioned in the presentation earlier, a trend does seem to be appearing where more companies are pulling product back within their supply chain. So rather than having it too close to final market, if they can use a step before pushing their product into that final market, it creates so much additional flexibility in the supply chain. If market dynamics change, there is a significant way to react to those market changes. A number of customers are also using the containers as part of that storage solution rather than pushing the product into final warehouses. And this also has a significant cost impact in terms of the traditional methods used in the past. We also see areas for optimization depending on what sub-segment your business stands. If you're talking large commodity producers, I think the hub solution is more relevant to them. If you then drill down to specialty chemicals, what we see there is the amount of utilization in containers. So quite often we are working with our clients to look at how they can improve the load fill, and we are quite surprised by how empty a number of those containers are and the ability to delay orders and improve load fill. What are the main challenges for companies we've worked with? I think when embarking on a journey, one of the main factors that influences that journey is change management. I know that is a general term, but what usually inhibits the possibility to move forward in changing supply chain is organizational alignment from the respective parties. Quite often we have had specific business units or specific regions who, because they're not aligned with certain initiatives, that can hamper any projects to optimize the supply chain. One more question I think we have time for. Typically, how long does this type of change in supply chain take to implement? Again, it's a difficult question to answer based on depending on the scale or scope of what those changes are needed to be. But if you were to use an example as mentioned earlier, again, what we see here is the first step is the most difficult, but once you have put processes into place, and once you've started to do the work within the IT architecture, the rest becomes much easier because it's more of a copy-paste reaction rather than having to reinvent a number of those processes or interfaces. So the initial steps take quite a period of time, but once that's been done, it can move much, much quicker after that initial step. So on that note, thank you all for, again, spending your time dialing into this webinar. I look forward to receiving any questions that you may have for me personally, and I wish you all a very good day. Thank you.